Hi, good evening, and welcome to each one of you. Thank you for taking your time off to join this webinar today. I would like to welcome all of you on behalf of Century. Sorry for the delay again. There was some technical difficulties, but I'm sure everything's sorted out right now. Please feel free to write your questions while the session is going on. I will try and answer all the questions before the session ends. And if you have any difficulties hearing me, or if you have any difficulties seeing the screen, please write in the chat as well. So let's start off today's session. So we are going to be looking at the technical analysis side of trading and investing. So we're going to be looking at different type of charts, different types of indicators, and different types of patterns that appear while you're doing technical analysis to make any decision before you start investing or trading. So let's move forward and understand what technical analysis is. Now, if you are already an experienced trader, please don't mind me going through the basics quickly for those who are very new to trading and investing. So there are two or three types of analysis that investors and traders do. The main one is the fundamental analysis. Second is technical analysis, and some of them even go into quantitative analysis. Two major analysis is fundamental and technical analysis. The major difference between fundamental analysis and technical analysis is this. Let's say, for example, you're looking at Tesla as a stock. Now, if you want to buy Tesla and invest it for a long term, you are more inclined towards doing a fundamental analysis of the company rather than doing a technical analysis. Although a combination of both, 80% being fundamental analysis and technical analysis to in combination to understand whether you want to invest in Tesla or not. But the main reason behind why you would invest in Tesla would be the main basis of the fundamentals of the company. You look at the past historical revenue that it has made, the progress it has made, the profit it has generated, and you are going to use all the statistics, all the information that you get publicly on Tesla shares to analyze and fundamentally find out if the company is fundamentally strong to be invested in for the long term. Now, of course, now when you do fundamental analysis, you majorly look at a long term investment time frame. When it comes to technical analysis, on the other hand, more traders and short term traders look at technical analysis more than the fundamentals. Reason being, a technical analyst looks at short term momentum to take advantage of the market. Now, when you're looking at a short term movement in the stock markets or any product, as an example, you will always be more inclined to look at a technical aspect of it rather than a fundamental aspect of it. Reason being, technical analysis deals with the price movement that happens on day-to-day basis, and also the price movement that has happened in the past to identify which levels the price has been oscillating towards, or from what levels the price has moved, and at what levels the price has dropped back down before it picked back up again. Now, if you look at a technician view, you will understand using technical analysis to take a short term decision would be more helpful rather than doing a fundamental analysis for a short term trade. However, both can be used equivalently, but primary use of fundamental analysis is always for the longer period, whereas technical analysis is something that traders use for a shorter period of time. Let's move forward today to understand different types of charting. Now, over here we have a line chart. We are looking at SPX as an example. All the slides that you see here are used only for demonstration purposes. All the indications and whatever we're going to be learning here, it is only for the learning purposes. Please do not use any of these to take a decision in the market as of today. I would always recommend, once you learn, please get in touch with your respective relationship manager, and they will be able to guide you forward if you want to take any quick investment decision for today. All the charts, all the patterns, and all the indicators that we will be discussing today is only for learning purposes. Now, a line chart, basically, we are looking at a SPX chart of a 10-minute time frame. So, as you see, there is a line chart that has been drawn, and each uh, 10 minutes you get a point where the line has been drawn on. For example, every 10 minutes, this chart by default takes the closing price and then waits out for the next 10 minutes and plots out the next dot where it is connected by a line. Eventually, it becomes a line chart. Very simple to understand, but very, very, very important when you're trying to identify patterns. A line chart gives you a much more easier visual aid to understand what kind of patterns you're going to be looking at. Now, these patterns happen fractal in nature, irrespective of whether you're looking at a 10-minute time frame or you're looking at a daily time frame, or sometimes maybe you're looking at a monthly time frame. Patterns remain the same, and within each time frame, the same characteristics of these patterns repeat, and hence it is fractal in nature. Let's go to our next type of charting, which is most commonly used as of today, that is the candlestick charts. Now, candlesticks is used by pretty much most of the investors and traders today while they're doing a technical analysis. Reason being, in a line chart, you have limited information, as in it shows you only the closing prices for each 10-minute, or if you're looking at a daily chart, it shows you a line chart based on the closing price of a daily closing. Whereas when you're looking at a candlestick pattern, each candlestick represents four distinctive features. Very simple, that would be the open price, the close price, how high the market went today, and how low the market went today. Now, let's take a look at this particular example over here. You see the price opened at the lower end of the candle and it went low. After it opened, it has made a new low. However, it has come back above its open price and eventually made a high and closed around this level. So, hence, it becomes a green color candle. Now, when you look at the red candle over here, you will see the price actually opened higher and it closed lower, and hence it becomes a red candle. So each candle also has its own unique characteristics on the way they form. While I'm showing you the live examples, I will be probably able to show you different types of candlesticks that get formed. But for understanding the body of a candlestick, the characteristics remain the same in terms of the open, close, high, and low. It only changes when the open is higher and close is lower, it becomes a red candle or a negative candle in this example. Now let's look at a few more common indicators that a lot of people look at is your support and resistance. Now support and resistance form when the market always moves both in both directions, especially on a smaller time frame. You will see market swinging both up and down, whereas on a longer time frame you would see market swinging up, and then after a long period of time you will see a downward swing before it reverses back up. But nevertheless, the market always moves on both the direction. Now, where a support and resistance is formed is whenever a market takes a swing. Let's take an example of this particular drawing over here. So here we assume that the market has gone up. For whatsoever reason, it did not reach beyond this level and it has dropped back down to a certain level, and the same pattern appears again for the second time. So every time you see a similar pattern happening 2 to 3 times, most preferably the third time, it becomes more evident of a stronger support and a stronger resistance. In this case, percentage wise, every time it rises a certain percentage, you see the market dropping back, and every time it drops a certain percentage, you see it bouncing back up. Now, this is one simple way to analyze support and resistance using percentage basis. So the most popular saying goes trade the bounce. So every time it comes back down, you enter technically on the support, and every time it goes back up, you book your profit, or you can also trade the break on the upside. Now, going to the next part of it, we looked at support and resistance in a wave format where the market has been trending. So you will see the market's trending, and hence the supports are always a higher support than it coming back to a similar level. Most ideal, but very less scenario cases. But there are good cases where you will see a market moving sideways for a long period of time. In this particular example, I've taken a very small time frame just to show you as an example. You see, in this case, we are looking at candlestick. If you have to see a line chart, basically it would have just been zigzag line without all the details. With the candlesticks, you have more details. You see, every time SPX went to 4140 levels, you see the prices dropping back down, and then it picks back up to the same level. Again, you see the prices dropping back down. Again, it picks back to the same level and it drops back down. Now, what does 4140 signify after the third time? It shows that there is a lot of resistance at that price, meaning every time the price is trying to breach above that, it is not able to, and hence it drops back down. So anyone who understands short selling would look at short selling on these resistance. Second way you could look at is, if this resistance breaks and sustains above this level, you can take 4140 as your support now, because now once it breaks above, you will expect the price to move higher. I will show you a couple of examples on these as well. Trend line, similar to the trending example that we looked over here. Now you have trend line support and resistance. When the market is trending downward, you will see every time it tries to go back up, it does not breach the previous high. In fact, it comes high but lower than the previous high, so it is known as lower highs. Every time it makes a lower high, it starts trending lower, and you can connect the tops of the candlestick or even a line chart. Now, in this case, you see every time it touches the trend line is where you can look at short selling. Vice versa on the buy side. Market has gone up. When it dropped back down the first time, it bounces back up. Now we are still not in the picture whether it's a trending market or not, but four uh, touch points later, you understand that this particular instrument has been trending upward, but on every correction it comes back lower is a buying opportunity if you're looking at a shorter time frame trades. One last one is the sideways, what we saw earlier. We have the same example here. In this case, you see every time it came lower to this certain point, it has bounced back up. So every time it comes to the lower end, a trader would look at a potential entry point for their entries. Now, keeping in mind all the support and resistance, both sideways, on a downward trend, on an upward trend, there are certain patterns that appear in the market over and over again. And it is not rare for these patterns to keep appearing. A reason being, the behavioral pattern of any price movement completely depends on the demand and supply. So let's say, for example, every time the price has come back towards the trend line, or let's take in terms of the dollar value, every time USD bond ultra came down, it was a value buy for someone who wanted to invest but did not get an opportunity. But now it is come down to a much better price so that they can buy into it, and when the prices rise back up, they gain from it. So the demand increases every time it comes towards the support, whereas on the higher end it does not breach above a certain point, is because most of them are either booking profits and exiting their buy positions, or the sellers are taking control to push the market back down. Basically short sellers and profit booking is taking place. Now, using that or keeping that in mind, let's look at a couple of patterns over here that has been formed, or a couple of patterns that you will identify while you're doing charting. Is, like I told you, a line chart would give you much more cleaner look. You can use candlesticks also and identify the same patterns, whereas line chart makes it more easier for you to draw your charting. Now in this case, you see this particular price movement, the market is not making a higher high, meaning it is not trending upward, nor is it making lower lows, so neither is it trending lower. So it's more on a sideway market. Usually sideway markets are known as consolidation, meaning people are not expecting the prices to go very high. At the same time, they're not expecting for the prices to come very low. So you see this pattern taking place. So this is known as a symmetrical triangle, because the triangle that forms between the lower highs and higher lows is pretty much symmetrical. How one would trade on a symmetrical triangle is if there was an upward market momentum, meaning the price has come all the way from a lower range and went on a sideway movement over here. There is a high probable chance after a consolidation phase for the trend to continue. So how one would treat this particular pattern is they would look for a breakout above the symmetrical triangle and take an entry by keeping a stop loss below the symmetrical triangle in case this particular pattern happens to fail and comes back down. The risk is managed, but if the pattern continues, they gain the entire upside on the market. We will look at a couple of examples of these on the live chart as well. In the meanwhile, please do let me know if you have any other queries, if you have any questions, if you want me to repeat anything, please feel free to write in the chat. Now let's go and look at a few other patterns. This is another ascending triangle pattern, similar to symmetrical, but since the triangle is not similar in the angle, it is known as an ascending triangle because the lower price have been closing higher. Hence, it is ascending. There's more reason for the prices to break above and continue the trend. Now, a few interesting patterns that you would also see is head and shoulder pattern. Now let's look at a proper head and shoulder pattern here. When the prices come all the way from the bottom and takes a reversal and makes a new high, and then drops back down and makes another high but not higher than the previous high, and drops back below. Now if you can see, on the right and the left forms the shoulder and the center is the head. So anytime you see a pattern such as this, is also a trend reversal pattern in this case, because the prices came all the way from the bottom. It tried moving up, there was not enough momentum, and hence it breaks back below. One would take a trade by taking a short on this position. Vice versa would be a reverse head and shoulder where the prices have dropped significantly and tried going lower, but it did not succeed and breaks back above the head and shoulder. This blue line that you see over here is known as the neckline. So a trader or an investor would look at taking a position once it breaches above the neckline by keeping a stop loss below the shoulder. I'll give you a couple of examples for this as well. Cup and shoulder, similar patterns, but it forms in a shape of a cup, and there is a smaller handle which again looks like a cup. This also is quite popular because once it breaks above a cup and handle, you can expect the price to move up as high as the distance of this particular drop that it has made. So let's assume that from the cup neckline to the bottom of this point is about 10%. Once a break above a cup and handle takes place, you can expect the prices to actually move close to 10%. However, not always the case. It can move even 20% above that. But the ideal target would be anywhere between 8 to 10%. And of course, the risk will be on the downside if it reverses and it's a false pattern. You have a stop loss right below this cup over here, which will be probably a 2% stop loss while you're aiming to achieve a 10% gain. So, still a good risk reward ratio. And few more patterns such as this, you see bull flags, meaning it looks like a flag before it continues. Bull flags are also very popular indicators. Every time the market goes up and it consolidates in a symmetrical angle on the downside, which looks like a flag, hence the name bull flag, and it breaks above the flag, you can expect the prices to move as high as the entire movement that it had had previously. Vice versa, for a bear flag, when the markets are dropping, it'll be vice versa. And this is a pennant. Now let's look at a couple of examples. Of course, you have bottom, you have double tops. There are multiple patterns, but let's look at few major patterns that appear most of the time. Let's look at this particular example. We see the price of silver has dropped. Okay, again, please do not follow these charts. These charts are only for demonstration purposes. Make sure you speak to your consultant before you take any trades. This is only for an example. Now you see silver chart dropping here and it makes a sideway movement. So if you remember, we saw a sideway movement over here. It's a descending triangle. In this case, you see a ascending triangle. Sorry, you see a pennant. A pennant is what you see over here, more like a bull flag. Markets have dropped, it consolidated sideways, and once it broke below the pennant, you see the prices drop further. Now, how do we know where to keep your take profit and stop loss? Your take profit will be the distance of this entire drop here. You can expect the same dollar or percentile drop on the lower end once it breaks below. So your entry point is once it breaks below the triangle. Your stop loss, of course, will be above the pennant, and your exit will be as long as the previous drop that you see in this image. Let's look at another example. Now you see a bull flag here. Market rallied up and it took a break. So every time market rallies, it always has a period of consolidation before it breaks continues. Either it's going to be a consolidation or it could be a trend reversal. Now, until and unless the flag breaks above, it is always best to wait it out rather than assuming it is going to continue the upside, because there are cases where this could have just dropped back down. In this case, once it breaks above the flag, is where you take an entry. Of course, now you can use couple of indicators to make sure the break is valid. We'll look at those indicators as well. In this case, you see it has broken above. If you had to enter after the break, you would have got the entire upside move, which is equivalent to this entire height of the rally. Now, stop loss again becomes very simple to keep. In this example, we have taken about 1 unit, which is worth $4,800. Your risk was about $134, whereas your profit was almost $350, which is not a bad risk reward ratio, 1 is to 2. Now, coming to the most important, most interesting thing that has occurred even on a larger time frame. If you noticed, we've been looking at a smaller time frame of 15 minutes, and I think the next one is about 2 hours. Now, let's look at the head and shoulder. Sorry, yeah. Here's the head and shoulder that has formed on a monthly candlestick. So here's a line chart giving us information of years and years of data in the past. In this case, I've taken about 3 years past. You see the market rallied, it took a break, it came down, it tried to make a new high, which again does not confirm a head and shoulder. It came back low. It again tried going higher, but at this point of time, it did not breach beyond the previous high nor the previous high over here. So, hence, this is very evident that this could be potential head and shoulder. However, it will be a potential head and shoulder only once it breaks the neckline. As you can see your arrow here, once it breaks below the neckline is where you look at taking an entry. Now, in this case, you will enter once it has broken below, and you keep your take profit again with the same height or percentile wise. The height between the neck's high, sorry, the head high to the neck is about 11%. So you can target 11% on the lower end. Now let's take an example over here. If you had to take a position worth $85,000, which is about 20 units, your risk would have been $5,000. Your reward would have been about $10,000. So again, 1:10. Sorry, 1:2. However, if your account value is a lower account value, instead of 20 units, you can always do 2 units. So your risk would be about $500 and your profit would be about $1,000. One more question that you might have is, why have I taken a bigger exposure here compared to the others where my exposure was lower? Now, when the time frame increases, the percentage of returns that you could make also increases. So you could always consider, because for this drop to happen, it could have taken even 4 to 5 months for the drop to happen, or sometimes even 8 months. So, in 8 months' time, if you are taking a trade or if you are investing it into something, it should be of some value for you in terms of returns. Now, let's say in this case, if you had to invest about $80,000, you would have got a profit of almost $10,000, which makes it worth your time and your investment, because you're looking at a monthly time frame. However, if you're looking at a very short term time frame, you can always go with smaller investment size, because you're looking to take advantage of a smaller gain over here in a smaller time frame. Now let's look at one of the indicator that you can use while looking at this chart, which is known as the relative strength index. Now, relative strength index is a oscillator. It's a momentum oscillator. It shows you the momentum when the momentum of an upswing is potentially coming to an end, or a momentum of a downswing potentially coming to an end. I will not get into the technicalities and the calculation behind RSI, but I will show you the more practical purpose of an RSI. In this case, you go to technicals and you search for RSI, you get your RSI. RSI is an oscillator, like I mentioned. It has a few characteristics over here. RSI basically goes down to 0% on the upside to 100%, and the midline is the 50%. Majority of traders or investors who follow RSI always keep an upper limit of 70% and a lower limit of 30. Some may vary, some may want to keep it more lower at 20% and 80% on the higher end. Now, how one would use RSI is always an oscillator which oscillates between the 0 and 100%, mostly between 70 and 30%. Now, every time the market rallies, the RSI indicates that the momentum is strong. However, once the momentum goes beyond a certain percentage and the market starts stalling, or the market stops the rally, you can expect the prices to turn back down. So, easy way to understand is, every time it goes above 70%, you can always anticipate for it to have a reversal over there. However, not every time it goes above the overbought region or the 70% mark means 100% reversal point. There could be chances where it goes above 70% and the market could still continue going up for a small period of time, or depending on the time frame you're looking at, before it makes a reversal. So always make sure, if you're using RSI, you also use your support and resistance and few other indicators to take your decision. So in this case, it took a reversal over here. It drops back down and it has come down to the oversold region. Now, once it has come down till the oversold region, you see the prices again bounce back up. Now, once the prices start bouncing back up and it goes back towards its oversold region, that is where you could potentially look at booking your profits. Average true range would be the last tool that I will be teaching for today's session. Average true range is a very good instrument or a tool that you can utilize while you're taking or making a trading decision. In very simple words, what an ATR or an average true range actually means is, it tells you how many dollars a particular stock can move in a given time frame. Let me show you an example over here. Now we are looking at SPX. Again, you go to the technicals, you find ATR over there. Once you click your ATR, it comes at the lower range, like how we saw RSI. Now I'm looking at S&P 500 on a monthly time frame to understand, if I am an investor and I am looking to invest my money in S&P 500, what kind of movement can I expect on an average in SPX every month? Now, please bear in mind that the movement can be on either direction. It can be on an upward move or it can be on a downward move. But I'm trying to understand, if I buy or if I want to invest in SPX, how many dollars can I expect SPX on an average to move as of today, on a monthly, in a month time. So in this case, you see it can move about $341. Whereas if you go back in history, the moment was hardly $100. So now, because the prices have gone up, you can see a movement of almost 10% in a month. Whereas if you go back in history towards 2012, 2013, the price was trading somewhere close to 1,000. And at that point of time, you see the market used to move $100. But again, in terms of percentage terms, it was still moving about 10% on an average in a month. Now, how do I use this to make my decision for trading is something that we're going to be applying practically and seeing on the live chart. I'll just be sharing the live chart with you. We'll just take a minute break and we'll get back to you. Thank you. Hi, welcome back. I'll be sharing my screen. Please let me know if you can see my screen. I think the screen should be visible for you all now. All right, so let's take two, three indicators that we've learned and try and implement that on a shorter term time frame to trade or find an opportunity. Let's take one indicator at a time. But before we enter into using RSI and ATR to identify a potential entry point for today, let's just look at the head and shoulder pattern, which I was showing you on in the example. Now you can see, once you draw your line chart, so this is how your candlestick would look, right? So on a candlestick, you use candlesticks to make decisions based on the red candle or the green candle or the type of candle it has formed. When you're looking at patterns, it's always better to use a line chart, because a line chart gives you more definition in terms of where you see a peak or where you see a dip. Now let's see that something that has occurred on a reversal pattern as well. You see the market had dropped here and it bounced back up, it drops again, bounces back up again, drops. Let me make this into yellow. Yeah. Now you can see that first initially it made a head and shoulder and the market dropped. Now it has actually made a reverse head and shoulder, whereas this would be the neckline. This is your neckline, right? Once the neckline breached over here, that is where you would look at taking a buy, and we'll come to the take profit and stop loss as well. I'll just make the font a little bigger so it's more easier for you all to see. I'm sorry, I think the fonts tab is not coming. Let me just try and make it bigger. Yep, I think this should be more clearer. Perfect. So I'll just try one more time if I can get the font. Sorry, unfortunately the font is not working. Let me open the chart again. I'm sorry, I'm just restarting the system. I think there seems to be a bit of technical issue with the chart. I have just reopened it. I think now it should work. Yes, perfect. Right. So I have just increased the font here. Now let's come back later to the take profit. Let's understand this particular pattern. What we learned, we saw the market dropping, which does not show us any pattern. Market bounce back up, still no pattern here. Market drops back down, no pattern. So once the third point where the shoulder has been formed, now this is where you start watching out to see whether it is a potential pattern or not. In this case, it bounces back up here, so we are waiting for it to break above. It does not, but eventually it did. So from here we can expect the prices to continue moving up and probably come back and take a support here. Now, once we identify a break at the neckline is where your entry opportunity comes. Now, let's use RSI also along with this and see what RSI gives us. So now you have identified one potential opportunity here, which is head and shoulder. And let's look at RSI. So RSI basically was almost close to oversold. It had not yet been oversold, but if you can look at it on a shorter time frame, let's say on a weekly time frame, you see RSI has been on the oversold region. Let's add ATR as well. So in this case, RSI has not given any clear indication of a reversal. It's purely based on the pattern. I'll go back to the monthly. Now, the second thing that we're looking at is your ATR. Now, like I mentioned to you, where do you use ATR to identify how many dollars can SPX move in a given month? Now, I'm going to change the candlestick pattern to, sorry, the line chart to candlestick now that we've identified our head and shoulder. Let me try and make this a little more brighter so it's seen. So we have our head and shoulder here. Now, as per RSI, sorry, as per ATR, SPX was moving about $370 at this given point in time. So once the neckline was broken, we can expect the prices to move on an average in a month by $385. So in this case, let's say from the neckline break, it can move about 385 or $380. Okay, I'm just going to go back to the line chart. So it shows it moved, it can potentially give us a profit of $380. Of course, we will not be entering exactly on the line break, we would be entering a little higher. So you can always uh, use, so this was a month of May. Probably you did not enter in the month of May, you entered in the month of June. In the month of June, we are expecting the prices to move up by, let's say, $380, which happened eventually in the next month. But however, it moved a $300 on the upward swing. That is one way to keep your take profit. Second way of keeping your take profit is by measuring the drop from the neck to the head. Now, from the neck to the head, you can see it has dropped about $500. So technically, from the break to the upside, you can measure a $500 upside move. And let's take candlestick. You see it has almost reached $500 before it started dropping back down again. Now those who follow patterns, they clearly keep and stick to the rules, which is very very crucial. Reason being, these patterns appear because a lot of people who are using these patterns will also look at the similar entries, and once everybody is entering on these prices, the volume goes up and hence the price moves higher. Now, every time it moves higher and there's a reversal, that means most of them know that the pattern has come to an end and it starts dropping. Now, we are not looking at the fundamentals of what is happening in SPX or what is happening around the globe. Now, although everyday negative and positive news will impact this moment, but since we are looking at a monthly time frame, in a month there could be 10 good news, there could be 10 bad news. So all those gets factored in within these moves. So let's say I go into I go into a 30-minute, or let's say a 4-hour time frame. So let's look at a 4-hour time frame of the same highlight that we had kept earlier. Now you can see the market even within this has given swings up and down. So anyone who was looking at a shorter time frame would not be able to take advantage of this longer term move, whereas a person who is looking at a longer term time frame will not be bothered about the shorter time frame swings in the market. So always make sure that whenever you're looking at a longer time frame, you're always looking for a bigger return in a longer period time frame, whereas when you're looking at a shorter time frame, you're looking at smaller returns in a shorter time frame. So the objectives are always different depending on the time frame that we are looking at. So this head and shoulder. Now let's go ahead and try and identify if we can get any active trades for the day using everything that we have learned. Also, if you have any specific instrument that you want me to talk about, or if you want me to show you on the charts over here, please feel free to write in the chat. All right, so we have Nasdaq here, a daily chart. Let's look at something on a very short time frame. Let's look at 5 minutes and see what's happening. So 5 minutes, this is my candlestick. Let's look at line chart. So line chart, as we learned, you can see a downtrend happening here. There was basically a sideway market at this point here. So there was this sideway movement that happened. So this is going into the past. So let's look at something where we can take advantage at current moment. So you see a downward movement. You connect the lower end of this. So we can see that Nasdaq is trending lower. So we can expect Nasdaq to take a support potentially somewhere here in the next few minutes. Okay. Now, if we are going with the support and resistance, let's quickly put in our order. You're looking at a 5 minute time frame, and I'm going to use ATR. So ATR tells me in a 5 minute time frame, every 5 minutes, you can expect Nasdaq to move about $20. So let's see how we are going to be putting our take profit stop loss. Of course, the stop loss is going to be below your resistance. Now that we have already drawn a resistance here, we can keep a stop loss below this, and we keep a take profit at the resistance. Now, if we look at the number of points, let's say I do 1 unit. So every $1 move, I will be losing $1 or I will be making $1. Technically, we will be entering on the support. Okay. And every time it comes down, like in this case, it is giving me a stop loss of almost $20, which is fair because the ATR tells me that on every 5 minutes it can move $5. Sorry, $20. So keeping a $20 stop loss makes sense. I can increase the stop loss maybe to 25 or 30 to give it some more room, or you can just go by the ATR. I will keep 25 in this case, or let's keep it 30, and let's keep a take profit of 60. And there we go. For today's examples, I will not wait for it to come till the support to buy. I will take a buy right now so that we can see what happens. I'll take a market at the buy. I'll take a buy at the market. Also, if you are okay with taking a little higher risk, in this case, there is an amount of $25,000. So if I do 10 units, I'm risking $300 to make $600 profit, which is very good. And it has come to a support, and I'm going to take the buy. Yeah. So now, just using simple support and resistance, we have taken this buy decision. Of course, it's on a 5 minute chart. Hence, we have to keep a stop loss because if it continues dropping, it could go much deeper on the downside. Good news, if stop loss triggers, my loss is limited to $300. And if it goes back up, I end up making a $600 gain. Now, let's look at what RSI is saying as well. Now, if you look at RSI in this example, RSI also has come to a oversold region. So now you have a trend line support, whereas RSI also has come to oversold region. There is a good potential to see a turnaround. Let's look at this RSI here. You see the market bounced back up, it came back lower again. In this case, it did not touch, so there was no double confirmation. However, on the trend line, it bounced back up. The third time the trend line is touching, it makes it a solid trend line. Like I told you, any particular level that it repeats the pattern more than 3 to 4 times becomes a strong support or resistance. So in this case, RSI is showing me oversold, trend line is showing me a support. ATR has given me my stop loss and my take profit, which again coincides exactly at the resistance. And this is a trade worth watching. If you have a demo account, I would recommend take it. If you have a live account, do not do it, because it completely depends on what portfolio you have and how much you're taking. So it's always best to talk to your consultant or your advisor or your relationship manager before taking a trade. This trade is only for your demonstration purpose. So let's just look. We'll be ending the session in the next 5 minutes. Let's have a look at what happens in the next 5 to 10 minutes, and we'll close the session. In the meanwhile, if you all have any questions, please feel free to write in the chat. I'm just opening the position here, so you can see your positions on the chart. I'm going to close the RSI so you can see the position with stop loss and take profit. And you can see the same. We have a stop loss here, we have a take profit here, and we have a current PNL which is about $170. So if it comes lower than this, it is always best to take the stop loss because you can always re-enter on the next opportunity. Majority of traders who do not succeed in trading usually comes the reason mainly the reason is because lack of risk management. There could be chances it might hit my stop loss and go back all the way up. So if that happens 1 or 2 times, usually as a human being, everyone gets disheartened and decides not to keep a stop loss. Now, not keeping a stop loss is very dangerous because in this case, we have taken a trade worth $140,000. So that means if market continues dropping and it drops every 1% it drops, you're losing $1,400. And then the loss becomes too big for you to close, and hence your account value will drastically start dropping. So it's always best to keep your stop losses, or you can take a trade within $25,000 so that even if it does drop and you want to buy more at the lower end, you can do that. But in this trading technique, we would always recommend always keep your stop losses, always stick to the rules of every technical analysis. Of course, you can modify according to your observation and your analysis, but make sure that your risk management is always well thought of even before taking a trade. I'm guessing no other questions for today. Keep an eye on SPX 500, sorry, on NASDAQ. If you have a demo or a live account, right now we have taken a buy on NASDAQ at 14,509. We have a stop loss at 14,480. That is about roughly about $25 down lower. And we have a take profit at 14,569, 570. So keep an eye on it and observe what happens. And for you to observe it on your own charts, you can put a 5 minute chart, and you can also keep a candlestick to see how it is performing. So this particular candle is turning back green. So there is signs of a reversal coming in. Our losses has reduced. But what I'm trying to say in this particular session is once you have identified an entry and you've got 2 3 signals to take the potential trade, and you have put your risk management in place, you can sleep peacefully after this because two scenarios: either it comes down you book a loss of $300, which is minimal. If it goes up, you will see a profit of $600, which gives you more opportunity to take another two trades later on. But make sure the stop loss is not modified nor the take profit is modified to get the best results, and you stick to all the rules. Thank you again so much for joining us again. My apologies for starting the session late. There were some technical difficulties. Please feel free to give your feedback on the chat, as well as give us your review on our Google reviews as well. Thank you so much and have a good evening. Thank you.